Welcome back. It's Richard Bliss again. Hopefully you've had some practice using the BSE template to enter transactions and then create financial statements. In this session, we'll quickly review the completed Year 3 and Year 4 BSE templates for Mario's Restaurant. After that, we'll spend most of our time looking at the resultant financial statements and beginning to understand how we can use them to analyze the health of Maria's business. So let's get started. Previously, we worked together to complete the Year 2 BSE template for Mario's and to then use the completed template to create an income statement, balance sheet, and statement of cash flows. We asked you to then do the same for Years 3 and 4 using the templates provided on pages 16 through 19 of your Scholar Workbook. Here's the completed BSE template from Year 3. This was created from the transactions on page 6 of your Scholar Workbook. Take a minute to review your template and make sure you are clear where each of the numbers comes from. Several points to note. The top row of the template is the bottom row from the Year 2 BSE template. This is the ending balance sheet for Year 2, which now becomes the beginning balance sheet for Year 3. The fundamental accounting relationship of the BSE, that is, assets equal liabilities plus equity, holds for each of the individual transactions. The totals on the left-hand side of the vertical line always equal the totals on the right-hand side. The last step is to total each column of the BSE template, which gives us our ending balance sheet for Year 3. Finally, remember that using the completed template, we can easily create the three main financial statements. Starting with the income statement, which is found in the last column of the template, retained earnings. We just need to rearrange the numbers to fit the standard income statement format. Next, we move to the bottom row of the BSE template, which provides us with our balance sheet data. Finally, the first column of the template provides everything we need to create the cash flow statement. All we need to do is to put each number into one of the three key categories of cash flow: operating, investing, or financing. Here are the Year 4 transactions entered into the BSE template. Please check your work. Now that you are an expert at creating the three main financial statements, let's move on and look at how we can use them. While understanding how financial statements are created is valuable, using the statements to understand the health of a business is even more important. What we'd like to do now is to move from building financials to analyzing them. You can find the financial statements for Mario's Years 2 through 4 starting on page 20 of your Scholar Workbook. Here's Mario's 3-year income statement. When analyzing this, we start by looking at revenue and its trend over time. While Maria's revenue declined slightly in Year 3, it increased almost 16% in Year 4. It would be good to know if these fluctuations were due to conscious decisions made by Maria or external factors beyond her control. For example, the 16% revenue increase could have come from changes to her menu or pricing, or simply be due to an improving economy. We can see that Maria's gross profit increased from Year 2 to Year 4, including a 29% jump from Year 3 to Year 4. One of the most important metrics for any business, but especially for retailers or manufacturers, is the gross margin. Gross margin is calculated by dividing gross profit by revenue, and it tells us how much the business has to cover its operating expenses. In this case, Maria's gross margin has increased significantly, going from less than 50% in Year 2 to almost 56% in Year 4. We now consider Mario's operating expenses. Most of these are pretty consistent over the 3 years, with the exception of wage expense, which increased 38% from Year 3 to Year 4. Note that this increase is significantly higher than the increases in revenue or gross profit. However, we know from the Year 4 transactions that Maria paid herself a $30,000 bonus. Without that, the increase in wage expense from Year 3 to Year 4 would have been just 18%, much more in line with revenue growth. Subtracting total operating expenses from gross profit leaves operating income. This is an important metric for any business, as it tells us whether or not the business's core operations are profitable. The good news for Maria is that the operating income is positive for all 3 years, although it did drop substantially in year 3. This appears due entirely to an increase in operating expenses, but Maria would definitely want to know more detail. Most importantly, operating income rebounds strongly in year 4, more than doubling from the prior period. We can calculate the operating margin by dividing operating income by revenue. We can see the margin drop by about 60% in year 3 before almost doubling in year 4. Take a look at Mario's 3-year balance sheet. As we analyze the balance sheet, remember that it tells us what the business owes and what the business owes. For Mario's, the largest asset is cash, which is just over $70,000 at the end of year 4. We can see that accounts receivable has increased significantly, presumably as Maria has granted more credit to her customers. However, even the year 4 number is small relative to revenue, so as long as Maria is collecting on time from her customers, she probably has little to worry about. Long-term assets are stable over the 3-year period. Note that accumulated depreciation increases each year as the fixed assets and liquor license continue to be depreciated. The overall change in total assets is not large over the 3-year period and is due primarily to fluctuations in cash and accounts receivable. On the liability side of the balance sheet, we can see that Maria has significantly reduced her current liabilities, both by lowering her accounts payable and by paying off all of her credit card debt. The most significant change in liabilities comes from her completely repaying the loans from her brother Fabio, leaving Mario's debt-free by the end of year 4. This fact, combined with the $70,000 of cash Maria has in the bank, would seem to say that the restaurant is healthy and has substantial liquidity. Finally, we examine owner's equity. Here we can see that the owner's equity has more than tripled over the 3 years, and this is due entirely to the increase in retained earnings. Note that Maria has not invested any more money into the business, as the contributions line has remained constant. The increase in retained earnings is due to the significant profitability that we saw on Mario's income statement. Overall, this is a very strong balance sheet. Now let's move on to the statement of cash flows. Remember that on the cash flow statement, we are interested in 3 categories of cash flow: operating, investing, and financing. We begin with operating cash flow, which is the lifeblood of all valuable and sustainable businesses. In Maria's case, the restaurant has generated over $100,000 of operating cash flow over the last 3 years. This is an impressive number for a relatively young venture. What did she do with all this money? A small portion of it, just over $2,000, went to purchase fixed assets in year 4, but the restaurant has required little in the way of cash flow for investments. On the financing side, we can see both the $30,000 that she borrowed from Fabio in year 2, and more importantly, the subsequent repayment of $80,000 to her brother in years 3 and 4. Finally, we can see that a large portion of the operating cash flow has remained in the business. Maria began year 2 with just $9,000 of cash, but ends year 4 with over $70,000. Now let's take a look at another tool for assessing profitability, the common size income statement. On a common size income statement, each line item is expressed as a percentage of revenue. Another way to think about this is it tells us what portion of each dollar of revenue is spent on the individual line items. One benefit of common size analysis is that it makes our analysis easier since everything is expressed in percentages, and this takes account of any increases in revenue. We previously discussed gross margin and see it again here. This says that in year 2, Maria had about 50 cents of each dollar of revenue after cost of goods sold. By year 4, that had increased to almost 56 cents. We also highlighted earlier the significant increase in wage expense, and the common size approach shows this clearly. From about 19 cents of every revenue dollar in year 2, Maria is paying 27 cents in wages by year 4. The rest of operating expenses stayed relatively stable over the 3-year period. Note that this does not mean they did not increase in dollars, but just that they were relatively consistent as a percentage of revenue. Finally, we can see that Maria earned between 4 and 9 cents of operating profit for each dollar of revenue. This number is positive in each year, and it more than doubled from year 3 to year 4. Up to this point, we have assessed the performance of Mario's restaurant by comparing financial data and metrics over a 3-year period. While this analysis is extremely valuable, we also often want to compare business performance with other companies, most often competitors. For this, we turn to a tool called SageWorks. Here is part of a sample report provided by a company called SageWorks. SageWorks collects financial data on private companies using a network of bankers, accountants, consultants, tax databases, and other sources. However, because this data comes from relatively small private companies, we always need to be careful in its interpretation. This report is based on NAICS code 722511, which is full service restaurants. More importantly, it only includes data from businesses under $1 million of revenue and located in California. Because of this, it is a good benchmark for Mario's restaurant. Note also that SageWorks provides data for a variety of time periods. The numbers in parentheses here represent the number of businesses represented in each column. We haven't discussed all of the ratios shown here. We will get to many of them in the upcoming face-to-face. They are also discussed in Chapter 3 of the Money and Metrics pre-reading. We did discuss gross margin, and we can see that for the SageWorks restaurants, this number ranges from 60 to 63%, depending on the time period. If you recall, the comparable values for Mario's restaurant was in the range of 50 to 56%. This is a significant difference with several possible explanations. Maria may be offering a lower priced menu in her restaurant, which could impact gross margin. Many business models are based on a lower gross margin, but then use operational efficiencies to keep operating expenses low and still achieve overall profitability. Another possible explanation is how each restaurant calculates their cost of goods sold. In some cases, it may be only the actual cost paid for food and beverages. Other restaurants may include some labor or overhead expenses. Because most small businesses do not have audited financial statements, these differences in practice can be significant. This section of the SageWorks report provides more detail on specific income statement items, including labor costs, rent, and depreciation. This information can be valuable when evaluating your own performance or also when considering a growth opportunity in an unfamiliar industry segment. Other parts of the SageWorks report cover balance sheet items and industry-specific data. For example, the restaurant report provides metrics on revenue per square foot and profit per employee, both valuable pieces of information for any restaurant owner. Each of you will be asked for your NAICS industry code and then provided with a complete SageWorks report customized for your industry, size, and geographic location. Now let's summarize what we've done over the course of Financial Statement Workshop 2. Understand that a firm's financial statements are simply the manifestation or footprint of the daily activities conducted by the business. This should help take some of the mystery out of where the numbers come from. We used a tool called the balance sheet equation and the basic accounting relationship assets equal liabilities plus equity to see how we can turn a series of transactions into the income statement, balance sheet, and statement of cash flows. Remember, the purpose here is not to replace your QuickBooks or other accounting system, but rather to help you understand where the information on each statement originates and what the statements tell us. Finally, we use the example of Mario's restaurant over a 3-year period to begin our discussion of basic financial statement analysis. This included looking at different profit margins on the income statement, assessing liquidity and financial health with the balance sheet, and understanding how cash flowed in and out of the restaurant. We will continue this discussion and begin looking at the numbers for your business in the upcoming face-to-face sessions. For now, step back and relish how far you've come. Our hope is that you are more comfortable with both the terminology and format of financial statements and are beginning to see how they can be used to evaluate business performance and make good decisions going forward. Thanks to each of you for your hard work to get to this point.